Welcome to the mid-2000s, when America's spirit was sky high and dreams felt close. You'd see smiling families eager to buy their dream homes in bustling neighborhoods. Feel the buzz as families tour vibrant houses, imagining their future inside walls full of hope. Banks were open arms, handing out loans like candy on Halloween night. Getting a mortgage? Easy. Just sign, and your American dream is practically yours. Real estate prices soared month after month, painting a picture of endless growth. You could almost hear the buzz of optimism echoing from every corner of the country. Parents dreamed big, kids dreamed bigger, all feeling untouchable in this golden era. You'd see lenders eager to keep the borrowing party going, no questions asked. Every signature felt like unlocking a treasure chest of endless possibilities. Imagine the streets humming with opportunity and bright futures, painted in cheerful hues. But behind all this glow, the currents of risk started to stir quietly. You probably thought it was all endless, yet the horizon was quietly shifting. Banks kept trusting, families kept buying, but the storm was silently brewing. It was a perfect recipe for a financial turning point few were ready to face. Right now, you can feel the tension building under the surface of that sunny glow. But this story of hope and risk defines the twisted dance of any economy. So next time you hear boom times, ask yourself, what's hiding behind the sparkle? The mid-2000s was a hopeful chapter, but one with lessons you'll never forget. Thanks for joining this journey. Dive deeper and see history through fresh eyes. By 2006, America was living the dream, home ownership was booming everywhere. Banks were handing out loans to almost anyone who asked, seemed easy and fast. But many of these loans were subprime, given to folks with less than perfect credit. At first, it looked like magic, families bought homes and prices kept skyrocketing. Wall Street turned those risky loans into safe investment packages, selling them worldwide. In 2006 alone, over $600 billion in subprime loans were issued. Investors, from pension funds to foreign banks, bought these thinking they were stable bets. Then the Federal Reserve started raising interest rates, and things took a turn. Monthly mortgage payments shot up. Suddenly, millions couldn't keep up. Foreclosure signs started popping up everywhere. Neighborhoods began to change fast. By early 2007, defaults on subprime loans had tripled compared to before. But Wall Street? They still bet the system would hold strong, refusing to see the cracks. No one wanted to imagine the world's biggest housing market could fall apart. So you see, what started as dreams of easy homes turned into a perfect financial storm. It's a story about risk, trust, and what happens when shortcuts break down. Understanding this crash helps you spot the signs and avoid the pitfalls next time. Subprime mortgages seemed like a jackpot but hit a ticking time bomb underneath. When interest rates rose, the house of cards started tumbling, fast and furious. Millions of American families lost their homes. The ripple hit the whole world. This crisis reshaped the economy forever, and it all started with those risky loans. Ever wonder how risky loans blew up the housing bubble? Let's dive in. By 2007, warning signs were flashing red across the market. Banks like New Century Financial and Countrywide were sinking fast. Their stock prices crashed over 90%, sending shockwaves to investors. Then, across the Atlantic, BNP Paribas hit a critical freeze. In August 2007, it froze 3 investment funds tied to U.S. mortgages. They called them impossible to value, a phrase sparking panic worldwide. The Dow Jones shed nearly 400 points in just one terrifying day. Banks stopped trusting each other. The lifeblood of financial markets froze. For the first time in decades, even short-term bank lending came to a halt. Central banks rushed in to save the day with massive emergency funding. They pumped over $200 billion in liquidity just to keep things moving. Yet beneath the surface, everyone sensed this was no small crisis. Interest rates were climbing fast, a clear red flag waving for all to see. Liquidity was crashing, cash was becoming as scarce as gold. Stock tickers kept tumbling like dominoes in a terrifying chain reaction. Bankers paced nervously, juggling worries they couldn't shake off. Newspapers screamed headlines, BNP Paribas freezes funds and credit markets freeze. You could feel the panic spreading like wildfire through the markets. This was the first tremor, a sign of the quake still to come. Stay tuned, the story of that quake is just getting started.
Then came 2008, the year the giant fell. In March, Bear Stearns mortgage funds failed, a financial earthquake. Its stock plunged from $170 to just $2 overnight, a dizzying freefall. JP Morgan Chase swooped in, saving the pieces with Fed's help. But hold on, this was just the opening act of the crisis. September 15, 2008, Lehman Brothers, $619 billion in debt, declared bankruptcy. It was the largest bankruptcy ever in U.S. history, a shock felt worldwide. In just 1 week, global stock markets lost over $4 trillion in value. Fear didn't just whisper, it screamed chaos across the globe. Banks stopped lending, even to each other. Trust vanished overnight. That spike you see? It's the London Interbank Offered Rate, hitting heights unseen since 1998. Panic spread fast. Merrill Lynch sold. AIG got a $180 billion bailout. Global markets went into freefall, like a roller coaster with no brakes. You'd feel it in the newsroom, tension thick like storm clouds overhead. It was the financial heart of the world, and suddenly, it stopped beating. Now, you see what happens when giants fall, ripples that shake us all. Ever wonder what lessons lie beneath these ruins? Stay curious, the story's not over. Next time, we dive deeper into how this crisis reshaped finance forever. Stay with us. History's biggest financial roller coaster isn't done yet. Like, share, and hit follow to keep uncovering the wild world of finance.
With the economy collapsing fast, governments had to jump into action. In October 2008, Congress approved TARP, a $700 billion lifeline for banks and automakers. You felt the shock when interest rates dropped to a record low 0.25%. That's history in the making. Meet quantitative easing, the Fed printing trillions to pump money into the system. It wasn't just the U.S. banks. Central banks worldwide joined the money boost party. Together, they unleashed over $2 trillion in coordinated global stimulus efforts. But let's be real, millions of people lost homes and jobs while the rich got bailed out. You must have watched the news, hearing about Wall Street bonuses as people struggled. By 2009, U.S. unemployment soared to 10%, painting a grim picture for families like yours. Global trade shrank by 12%, the sharpest drop since World War II. You probably wonder, why are those who caused the crisis the first to get saved? This question echoed from homes to social media, voices demanding justice and fairness. Across the world, governments tried to calm the storm with more spending and help programs. But recovery was slow, and many felt the rescue mainly favored the wealthy elite. You saw headlines blaming Wall Street while Main Street struggled to stay afloat. Yet, the bailouts arguably prevented a total financial meltdown overnight. The Federal Reserve kept printing money, hoping confidence would return to the markets. But you felt the uncertainty, a real roller coaster with no clear end in sight. The 2008 crisis reshaped how governments handle economic disasters worldwide. Now you're watching history in the making, asking what comes next for you and the economy.
The 2008 financial meltdown wasn't just an economic event, it was a wake-up call. It showed how fragile the world becomes when debt, greed, and unchecked optimism collide. Since then, regulations have tightened, and your awareness must grow too. But even today, new bubbles pop up in tech, crypto, and housing. The cycle of boom and bust. It's like a risky roller coaster daring you to ride. Here's the real deal. Prosperity without prudence is a ticking bomb. Understanding risk is just as vital as chasing reward in your investing journey. Because history might not repeat exactly, but man, it sure loves to rhyme. You've got the tools now. Learning from past mistakes keeps you ahead. Keep your eyes open, your mind sharp, and your decisions smart. That's how you turn lessons into lasting financial strength. Looking back helps you move forward wiser and more prepared. Your journey through investing isn't just about money, it's about mindset. Stay curious, stay cautious, and remember, every bubble eventually pops. But with knowledge and patience, you're no longer just riding the wave, you're steering it. And that's the real power of lessons learned from the 2008 crisis. Your story as a young investor starts with understanding the past clearly. So next time you spot a bubble, you'll know exactly how to handle it. Look up now, see that hopeful skyline. That's what recovery looks like. Thank you for watching.